So now pivoting away from the geopolitical and looking at the EM's inflation index. So this is Citigroup's index of emerging market inflation. And as you can see, the emerging market inflation surprise index jumps to the highest since 2008. This is not going to stop. And there's still more price increases to come if we look at what is happening in raw materials, what is happening with food. Soybeans are up another $28 to $16.43. Or I should say 28 cents if I start to normalize it to $16.43. The pressure is there and it's going to continue to go up. Now, it's at some point, and it's not yet because it's going to continue to drive higher. At some point, it's going to peak. And the problem with that is I don't believe it's going to come back down. It's just going to stay elevated for an extended period of time, which will put more pressure on bonds, which will put more pressure on the local economies, which is why when we talk about oil demand and what comes next, there is a lot of economic pressure that remains in place that is going to limit the amount of activity that I think the market is expecting. So then if we take it to another level and look at U.S. factory wait times for materials and supplies are the longest in records to 1987. So it's taking more and more time to get an average lead time for production materials is at 80 days. Average lead time for MRO supplies is at 47 days. So the length of time, and this is where we talk about in the EIA show, we look at ports, we look at trucking, we look at rail. It's not getting better. It's actually getting worse again. And the fact that we have a significant amount of COVID cases at some important areas that produce the raw materials, this is just leaving more and more pressure in the supply chain that is not going away anytime soon. And it just continues to mount and put additional cost in the system that gets passed through to some point. Now, when we look at metals subindex, this is just the Bloomberg's metals subindex, you can see just where we sit. And obviously we're off of where we were in 08, 09, but it doesn't mean that we can't get there. Given the supply shortfalls, given some of the reopening in terms of the movement of demand, the pressure within inventory, because inventory levels are still at near historic lows, if not record lows, which means that we still need to replenish inventory and meet demand, which is why we still believe that the pressure is to the upside. Even though we're seeing Chinese credit impulses roll over, we're seeing the slowdown in China, it's just not being carried through the market because there is a significant supply disruption that is on the back end of this as well. And then making matters worse, China makes its fifth biggest single day purchase of U.S. corn in history, which is why when you look at just what they're trying to do, they're trying to supplement their drawdown storage as well as buy feedstock, not only for their citizens, but also for to rebuild their swine and chicken herd, chicken flock, swine herd, because there is a huge shortfall on the protein side, which is why we continue to see beans get bid so hard, because soybeans have that protein component that can be put into the diet, which is on the other side. Now, considering the purchases, we have to factor in the drought. This is what has created these shortfalls. We had almost 97% of destruction within the Yangtze River basin when you look at livestock and crops. Well, look at the U.S. Let's look at the drought regions that are continuing to hit, that are creating, the limitation on yield. And it always comes down to what is yield going to be and what is supply. So there's bumper crops, and then just based on what we're seeing right now, this is going to be a very tight market because China's already buying next year's crops, again, leaving some of these additional pressures on pricing in the system, which is turning around and sending UN world food prices to a year-over-year high. So when we look at 30, and again, this is the year over year where you can see it dipped. I'm not saying it didn't, but look at where it has gone in general on a year over year level. And this is not even including, because this is struck as of April, the most recent push higher, which is why when we turn to the UN food, which is where we start to look at, the pace or the rate of change can start to adjust, but the trend is continuing to go up. Now, the problem that we continue to see when we look at food insecurity, the pressure on wages and the broader market, the trend is going to be up. So even if it doesn't go up as fast as it has in previous months, it's still moving in the wrong direction as wages are not keeping pace and inflation is hitting not just food, but other ways of life, which again is just draining more from just general income. But the one problem is one of the things that we think is going to happen when we look at 2010 through 2014, how things stayed elevated. We just see it remaining elevated when you look at the shortage on livestock and just the shortages around the world that have been created based on just COVID, but also population growth and inherent supply chains from disruptions from armyworm to droughts to not getting enough boats to flooding. And, one of the things that we talked about last week, when you get droughts, you also get lower water levels. If you get lower water levels, you can't move barges as fast or fill them as high, which again leaves more in the system. So then when you look at China snapped up corn to feed its herd and replenish reserves. So you can see just the level of purchases that remain in the system. And again, the 2022, they're already buying next year's crops, which just based on what we're seeing is going to continue to accelerate. And when we look at U.S. exports, so where are the exports going? Because we continue to send a significant amount of product into the world. So you could see rest of the world. And it's, even though we've talked about China because it's sizable, it's not just them. We're continuing to send more and more into the system. You can see there's a lot of Japan, and Asia in general is struggling just based on, as we've been talking about with inflation, but crops drying out, not getting the what they need. Latin America not able to meet that demand level, which again is pushing them back into the U.S. market. And just looking at our drought monitors and what we're seeing, there's pressure within the system that remains as well. Now, when we look at inflation, it's always important to talk about China's consumer and producer prices. So when we look at just the headline, so you could say, okay, CPI didn't go as high as expected, but what isn't as high? Because when you look at it, you could say, okay, well, PPI just didn't get passed through to the consumer yet. It's still going to get passed to the consumer, because when we look at headline PPI at 6.8%, and then PPI of producer goods at 9.1%, this is going to become a bigger problem because it's on the business side still. And where does the U.S. get most of its goods? China. So when you look at PPI on a producer side and just as a headline number, this is going to continue to flow through the system, through the supply chain into the U.S., which is why we continue to talk about CPI. Inflation in general is not done. And let's look at rates. Well, rates are not exactly supportive for getting stuff into market, moving it throughout the world. So when we look at container rates, you can see coming from Shanghai, they've exploded higher. And when you look at the composite, it's at $5.5 thousand, where initially it was at $2,000. And now these are the things that are continuing because it's roofing everywhere. It's not just one or the other, though it is a supply chain problem throughout the whole world, originating from or going to China. So then when we look at the supply chain, because again, yes, there's more demand, but you have to look at production. So let's just take one for an example, look at Brazilian iron ore production. So the Brazilian rebound should loosen the global market. So when you look at production growth, look at 2020 and just the shortfalls, 2019 into 2020, the shortfalls that continue. So now we need to see, we need to see Brazil close this gap, because when you look at 19 into 20, this is where, yes, there's going to be more raw materials, but how quickly can they get into the market? What is the demand going to look like? Can we get that supply? These are the friction points that are going to keep some of these prices elevated for an extended period of time. Now, we keep talking about or hearing about, oh, well, it's all because of autos. Well, let's look at autos. Like after the initial rebound, auto production has fallen back down again because they're not getting the chips that they need, the raw materials. So we're still seeing a very elevated car price because we haven't seen auto production catch pace. And it just based on what's been announced, we're going to continue to see these shortfalls permeate well into the summer, again, creating this almost self-fulfilling feedback loop. And when we look at global sales, so global sales are almost getting back to normal, but auto production continues to fall because of those supply chain issues, which is keeping that bid in the used car market, which is keeping that bid in new cars, and again, pushing those prices ever higher. So then when we turn around and say, well, U.S. motor vehicle and part dealers inventory to sales ratio, so you can see that it continues to go lower. And it's anyone who's tried to get a car fixed. I know for myself, I've tried to get a car fixed. It has taken almost 30 days to get it fully fixed. It's better than what it was because they had said that it was horrendous and it took up to 60 days in last year. But there's still that residual. And one of the things that at least I've seen or experienced is that it's getting worse. And when you look at some of the data, it got a little bit better and now it's getting worse again. And it's something that is not being fixed, or it closing that gap is going to take an extended amount of time. And then when you look at, well, what does the activity look like? What is that capacity? The employment recovery from pre-pandemic levels, you can just see it's not just a U.S. problem. It is a global problem. We're just not seeing employment come back, which is going to limit the amount of just end market demand that is going to be needed or seen in the global arena, which is why even though we're seeing these shortfalls, the supply chain will start to catch up. But, as the supply chain catches up, well, what does employment look like? Are people going to want these goods? What is inventory? And right now you have a more captive audience because inventories still remain low. So people have to buy at these levels. So there will be a point that the market rejects higher prices. It's just we're not there yet. And even if they reject higher prices, even the supplements, even the way that you can move into some other product, all of those prices have also gone up. So inherently, your day-to-day life will get more expensive. And now when we look at just population outlook, because it's something that we want to talk about because it's a big problem that isn't appreciated at the level it should be. Because when you look at the population outlook and the shift in general, this is looking at UN projections, NBS, in terms of what came from the National Bureau of Statistics from China. So you can see that there is right now we are tracking the white line. And we had a little bit of an increase, but the growth rate is slowing in China. It's slowing around the world. And this is something that we're going to talk about specifically on China in the last segment. So then when we look at labor declines, which add to the growth challenge, so we're getting less people working while the population is getting older and we're not getting as many people to supplement the baby boomers in the US and some of the other regions. And this is when you look at the replacement fertility, the fast raise, we're seeing this pressure where low fertility, no raise in retirement age, replacement fertility, fast raise in retirement age. We're getting to this pressure point of people coming out of the workforce. And this is creating this negative feedback loop in employment growth across all major economies, which again is going to limit the amount we can see a true recovery, or what kind of movement can this recovery really have, because there's so many things that are coming to more and more pressure across the board. And again, these are those pressure points that we want to talk about because they're going to continue to reverberate through the system and drive some of the additional weakness that I don't think many appreciate nor understand the risks that come with these type of issues. So that's enough of that. We'll talk a bit more about population growth in the last segment, but in this coming segment, we're going to talk more about what these initial inflation numbers look like and what do we expect going forward.